Hi, welcome to the market alert for Thursday, the 13th of November 2013. Starting off with the early part of yesterday's session, you can see the pre-market there, the market trading down from the 17,600 all the way down to the 17,550. We then get the market finding support at the S2 level, that's the support 2 level of the pivot points there. We get the trade being signaled there, so I'll just mark that one up for you. And what's great about this is that the market's got to go through the support, the psychological area there, the resistance at 17,550, and it does this by driving through with a professional buying bar, even though there was some selling prior to this. So you can see the market then driving, more potential weakness, further buying coming in, and then eventually we see the market hitting the scalp, trading up to the previous day's low. This market had traded lower all morning from the highs, which you can see there. So coming all the way down 50 plus points there, down to the 17,550, and then of course making its way back up to the highs thereafter. But what's interesting is what happened after. And as I spoke about in yesterday's market alert, that I'm going to be giving more and more insights into how to read these markets outside of the PTPs and triple X's. Let me just show you two very important pieces of information here. You've got the market trading back to the psychological level. You've seen how powerful these are during the last few weeks. Well, if I actually just draw a Fibonacci retracement from this low up to this high, you'll see the market stopped between the 76% area there and also the 62. So the 62-76 area, which I will be doing a video series on, how you can use these to find where the market is likely to find support. You could have actually brought back into this market because of 1, the psychological level, 2, the 62 and 76% area support there, which is a very, very powerful indicator indeed. So I will be showing you more about that in forthcoming videos, and I can look at the chart and I can see this all over the chart. Just a quick one there, you can see the market's pulled back and then started to move higher, and again if I just draw that in, you'll see the market stop there. So a lot of new tools to come, a lot of exciting ways of looking at the market, and real ways as well. These are real-time indicators and not just lagging indicators. We can see the market pre-market here, the Dow has continued to move higher, and if we move to the daily chart, you'll see we have a new all-time high. The insanity prevails, the Ponzi scheme continues to move onwards and upwards, and I wouldn't be surprised if we don't see 20,000 on this one before we get some sort of pullback. And the reason I say that I will explain in just a moment. There are a couple of reasons for saying that, but let me just put on the zero extension there for you. You've got 17,680, nearly 17,700. We're only 2,000 points, 2,300 points away. And when you look at how much the market's moved in the last 6 weeks, well, not even 6 weeks, 5 weeks, you can see that this market has some upward momentum. And the reason I'm making this bold sort of a statement, I suppose, is because I can't see why the market would come down at the moment. We're heading in towards the Christmas buying now. We're heading into the fourth quarter in the US, and so the figures are going to be fudged for that. And not only that, ultimately the Federal Reserve don't want the market to go down. They certainly don't want it to go down before Christmas, and the bankers won't want it to go down before Christmas so that they can trouser their massive bonuses in January when they square off the books. And fourthly, the Dow is normally, well, not normally, the pattern is and has been for time immemorial that there is a rally between October and December. So I can only see this continuing to move higher. The odd down day, sideways day that we've seen here, but I don't see anything major at this point. And finally, the fifth reason for this is in the implied volatility. We're at 10.13. This has got to go lower, More importantly, this historical volatility has got to come back down here as well. It's starting to drop quite fast now, but until that happens, we're not going to see a major correction in the market. So the long side remains the best side, apart from the odd days where you will get pullbacks, of course. Any short trades are likely to be, as in the name, short, not offering too much to the downside, unless, of course, that one caveat that there is any sort of geopolitical reason to move the market lower. Just go back to the daily chart. On the news front today, we'd have absolutely nothing. We've only got crude inventories after the markets opened at 4 p.m. and at 3 p.m. Medium impact news on the JOLTS job opening. So, and that's looking at the figures there, more or less forecast to come out as what it was before, and it's medium impact. So I don't think it will have too much of an impact on the market, he says. So, but it's medium impact. So unless there's a massive difference and disparity between the two figures, then we should see everything remain the same when that news item is released. But all-time highs being made on a daily basis, apart from yesterday, as we've seen all the way through. And I can't see this not continuing at the moment. The long side is the best side, and as I keep saying, the insanity prevails. Right, I will see you in tomorrow's edition of the Market Alert. Have a good day. As ever, thank you for your support. Very much appreciated. And as ever, thanks for watching. See you in the next one.